Most people will never get rich, not because they don't make enough money, but because nobody ever taught them what to actually do with it. Today that changes. I'm going to show you the exact strategy that has quietly built more millionaires than any business idea, any side hustle, or any get-rich-quick scheme ever invented. It's called long-term investing, and by the end of this video, you'll know exactly how to use it. Before we talk strategy, you need to answer one question. What does rich actually look like for you? Because the answer is different for everyone. For some people, rich means freedom. No mortgage stress, no paycheck to paycheck panic, enough in the bank that losing your job doesn't destroy your life. For others, rich means the lifestyle, the car, the travel, the house that makes your neighbors ask questions. That definition matters more than you think because it determines your entire investing approach. If you're building toward financial freedom, a solid retirement, a home you own outright, wealth you can pass down, your strategy is patient and consistent. Index funds, 3 to 6 months of living expenses sitting in a high yield savings account. This is your safety net. It means you never have to sell your investments at the worst possible time just to cover rent. Step 2. Get proper insurance. Health, auto, home or renters. One catastrophic event without coverage can erase years of progress overnight. Step 3. Kill your high interest debt. If you're carrying credit card balances at 20% interest, no investment in the world beats paying that off first. You cannot outinvest a 20% guaranteed loss. Once the foundation is solid, automate your money. A simple starting framework: 50% to needs, 30% to wants, 20% to savings and investing. The exact percentages are less important than the fact that it happens automatically before you can spend it. Set up an auto transfer the day you get paid and you'll stop missing the money within 2 months. You will never find the perfect moment to the largest companies in America: Apple, Amazon, Microsoft, Google. When you buy an S&P 500 ETF, like Vanguard's VOO, you own a small piece of all 500 of them with a single purchase. You're not betting on one company, you're betting on the American economy. And over the last century, that bet has never lost over any 20-year period. Ever. This is literally the strategy Warren Buffett recommends for most people. Not stock picking, not market timing, just buying low-cost index funds and holding them for as long as possible. It's boring, that's exactly why it works. As you grow, you can expand. International stocks, individual companies you believe in, real estate. But when you're starting out, the S&P 500 is your foundation. Once your portfolio starts to grow, say $50,000 to $100,000, it's time to think bigger, because different assets perform differently depending on what the economy's doing. When stocks crash, some other assets hold their value or even rise. Spreading across multiple asset types is what protects your wealth from any single storm. Real estate is one of the most powerful tools available. You put down a fraction of the purchase price, the bank funds the rest, and a tenant's rent covers your mortgage. Over time, the property appreciates in value. You're earning passive income and building equity simultaneously, two income streams from one investment. Make is to stop moving. Automate your monthly contributions. Money flows from your paycheck into your brokerage account and automatically buys your index funds. You don't monitor it daily. You don't react to headlines. You don't touch it. Because the biggest threat to your wealth isn't a market crash, it's your own emotions. People panic sell when markets drop and lock in losses. They chase the hottest stocks when markets are soaring and buy at the peak. They constantly tinker, convinced they're being strategic. And they consistently underperform investors who did absolutely nothing. The best long-term investors are boring on purpose. Warren Buffett's preferred holding period is forever. He buys great investments and lets decades do the heavy lifting. Set the system. Trust the system. Let compound interest work quietly in the background. Your job is not to be active. Your job is to be patient. At some point, you're going to check your portfolio and feel sick. You'll see it's down 20%, 30%, maybe more. And everything in you will want to pull your money out. Don't. Market crashes are not anomalies. They are a normal, expected feature of investing. And more importantly, they are always temporary. When markets fall, stocks go on sale. The investors who got rich weren't the ones who ran. They were the ones who kept buying when everyone else was terrified. Stay calm. Keep investing. Panic gets punished. Patience gets paid. And that's the whole game. Long-term investing isn't complicated. It's just consistent. Build the foundation, automate the habit, diversify as you grow, and never let short-term fear kill long-term wealth. If this helped you, check out our next video and start today. Not tomorrow. Today.